liability. That even if you don't have the title, if you take on the function of running the business and telling people what to do and actually controlling things, you can still have personal liability. So in all of these, we're the limited partners here, or in this case, the general partner and limited partners have no vicarious liability, they can still have actual liability. In this case, just like in the limited liability partnership, the general partner can run things and they're responsible for what they do and what they should do. Limited partners, if they actually participate in the running of the business, can have liability. Any questions so far? Okay, I want to get into a little bit more into limited liability companies, because as we mentioned before, that's the way a lot of businesses are now being formed when you go to an attorney and there's more than one owner. Oftentimes, even when there is only one owner, limited liability companies are also formed. So, a single individual can also form a limited liability company. Sometimes people will come to me and they'll say, hey, I heard that that if I form a limited liability company, I don't have any liability, so should I form one? So I say, well, do you have any employees? And they say, no, I don't. I said, who runs everything? I run everything. In the course of your business, do you drive a car? Oh, yes, I drive a car. I make sales calls all the time. And so I tell them, well, in actuality, having a limited liability company is not going to give you that much liability protection, because you're doing everything, and if there's any kind of a liability, like an automobile accident, and you're always on the road, you're likely to get sued because you're the one that's actually driving the car. And so long as you understand that the limited liability company does not protect it from that type of liability, then it's okay. But where it does help is where you have, let's say, 3 people, and only one person is running the business, and the other 2 are only investors. In that case, the limited liability can provide liability protection for the people who are not active. Now, why would you form a limited liability company versus a corporation? Because the same thing is true of a corporation, that a stockholder can invest in a corporation and be a silent stockholder. Somebody else runs the company, and the stockholder is not vicariously liable. And I think one of the things we said is that limited liability companies are a lot more flexible, which is true. But can somebody else tell me what other reason there might be for people to form entities like limited liability companies, limited partnerships, things of that nature, rather than a corporation? One big reason as to why you would do it, let me go back to page 1, is that in corporations, especially a C corporation, there is no flow-through taxation. What happens is that C corporation files a tax return, and the C corporation pays taxes. If the C corporation then wants to distribute money to the stockholders, unless it pays a salary, unless it pays rent, something that's deductible, what happens is that the corporation doesn't get a deduction for paying dividends, and the stockholders pay taxes on the money that they receive. So that's called double taxation. So that's one of the reasons why people want to form one of these entities, like a limited liability company, rather than a corporation. With an S corporation, by the way, these entities don't pay taxes. They don't pay federal income taxes. They pay general excise, state general excise tax, but they don't pay federal income taxes. What they do is they file a return that just says, we made $100 this year, and $50 of it goes to Caprice, and $50 of it goes to Tiari. And the Caprice and Tiari would put it on their tax returns, and they would pay the taxes. So there's only one level of tax rather than 2 levels of tax. In an S corporation, That's also true, but it's very strict. If you own 50% of the stock, you always get 50% of the income. If you own 25% of the stock, you always get 25% of the income or loss. With an LLC, triple LP, limited partnership, limited liability partnership, and general partnership, every year you can agree to change that. You can say, well, this year we had so much in regular income and so much in capital gains from selling property. We're going to divide it up differently. And it's flow through. Or you can say this year, even though we're 50-50, we're going to allocate 60% of the income to one person and 40% to the other. And the following year, 70-30, depending upon how you want to divide it up. So for those purposes, these entities are much more flexible. So that's why we get to a situation with the limited liability company where, for all practical purposes, for liability purposes, it's almost the same as a corporation. Nobody has vicarious liability, and only the people that you appoint to run the company have actual personal liability. Okay, limited liability company. So that's the other difference that I didn't mention earlier, and I had mentioned that I would explain the difference between an S corporation and a C corporation, and that's the difference. Okay, so for limited liability company, this is where we are. This is where we're forming most of our businesses. What are the types of things we need to know? So one of the things that we know is that the limited liability company, like the partnership, you need an agreement. You need an agreement that spells out what the deal is. Because in limited liability companies, you may have somebody putting up 80% of the money. And you may have the other person who put up 20% of the money doing all the work. So you have to then decide, well, what are the consequences of that? What happens when the business ends? Who gets to run the business? If you appoint somebody to run the business, then what authority do they have? So let's go through the running of the business first. One of the things that you'll hear is a limited liability company is either member managed or manager managed. And you have to state that right in your articles of organization that you file with the DCCA. So you have member managed, or manager managed. Member managed means that to the outside world, each member has an equal right to run the business. And unless you agree otherwise, to the inside world, that is the members, well, by the way, member in a limited liability company, the member is the owner. Okay? When you say member, you're talking about the owner. Like the stockholder is the owner of a corporation. The partner is the owner of a partnership. The member is the owner of a limited liability company. So in a member managed, each member has an equal right to run the business. In manager managed, only the manager or managers have the right to run the business. Everybody else is silent. So in a manager managed limited liability company, you may appoint just one person to run a company that's owned by 5 other people. In a member managed company, each member has a right to run the business. Even in a member or manager managed company, you still want to have an agreement as to what authority the members or managers have to make decisions. So a lot of times you'll say, well, whichever one it is, member or manager, anything over $10,000, you have to have a majority of the owners agree. Anything over $100,000, you have to have 75% of the owners agree. Any contract for longer than 1 year, you have to have a majority of the owners agree. You can't just have one member making that decision. So that would go into the operating agreement. The other thing to note is that for purposes of vicarious liability,